Hey there, welcome to Money Talk Tips, where we make finance easy peasy lemon squeezy. Today we're talking about something you probably heard of but might not fully understand. Bonds. Don't worry, we're going to break it down so it's crystal clear. Let's jump in. So, what exactly are bonds? Well, think of them as fancy when you buy a bond, you're basically lending your money to someone, like a company or the government. In return, they promise to pay you back the money you lend, plus a little extra called interest. It's like loaning your friend $100, and they promise to give you $110 back after a year. Bonds come with some important terms to know. First, there's the face value, which is the amount of money the bond is worth when it matures or reaches its due date. Then, there's the interest rate or coupon rate, which tells you how much extra money you'll get. For example, if you have a $1,000 bond with a 5% interest rate, you'll get $50 in interest each year. Bond price and coupon rate have an inverse relationship. Higher coupon rate, higher price. If a bond has a higher coupon rate, the interest rate it pays compared to its face value, it tends to have a higher price. Lower coupon rate, lower price. Conversely, if a bond has a lower coupon rate, it typically has a lower price. Here's why this happens. Market interest rates, the price of a bond in the secondary market where bonds are bought and sold after their initial issuance, is influenced by prevailing market interest rates. If market interest rates are higher than the coupon rate of a bond, new bonds being issued will have higher coupon rates to attract buyers. Price adjustment. To make an older bond with a lower coupon rate competitive in the market, its price must decrease. This is because investors are willing to pay less for a bond with a fixed lower interest rate, when they can invest in new bonds with higher rates. Example, let's say you have two bonds, Bond A and Bond B. Bond A has a 3% coupon rate, and Bond B has a 5% coupon rate. If market interest rates rise to 6%, Bond A becomes less attractive because it pays less interest compared to the market rate. To make Bond appealing, its price will fall, so its effective yield interest rate based on its lower price matches the market rate. Bond B, on the other hand, still pays more than the market rate, so its price remains stable or may even rise. Bonds come in different flavors. There are government bonds, which are like the most trustworthy ones because, well, it's the government. Corporate bonds are from big companies, and municipal bonds are from local governments. They all have their unique perks and risks. Now, how do you get your hands on these bond goodies? You can buy them through a broker or sometimes directly from the issuer. And if you ever want to sell them before they mature, you can do that too. Just keep in mind that the price might go up or down based on what's happening in the world. So, why even bother with bonds? Well, they're like a cozy financial safety net. They're generally less risky than stocks, making them a good way to balance out your investment portfolio. Plus, that interest we talked about, it's like free money. Who doesn't love it? And there you have it, bonds made simple. They're like lending your money to others and getting paid for it. If this video helped you grasp the bond concept, don't forget to hit that thumbs up, share it with your friends, and subscribe to Money Talk Tips for more easy-to-understand financial tips. Thanks for joining us today, and until next time, keep it simple, keep it smart, and keep it fabulous. Catch you in the next video, where finance meets fun. Stay tuned.